In today's video, let's talk about how I'm thinking about investing in the US stock market in 2026. I've been reading your comments, and many of you are asking the same important questions. Will US stocks continue to rise in 2026? Are valuations already too high? Did we miss the opportunity? Or is there still room for growth? To answer these questions, we need to understand one simple truth. The stock market in 2026 is not being driven by headlines or emotions. It is being driven by liquidity, interest rates, and Federal Reserve policy. Right now, we are in an easing environment. The Federal Reserve has moved away from aggressive tightening and toward supporting the financial system. When money becomes cheaper, borrowing increases, risk appetite rises, and asset prices tend to move higher. This is not speculation. This is how modern financial markets work. The most important concept you need to understand for 2026 is liquidity. Liquidity simply means how much money is available in the system and how easily it can move. When liquidity is tight, markets struggle. When liquidity is abundant, markets rise. Think of liquidity like water in a pool. When the water level rises, everything floats higher. In 2026, that water level remains elevated. Many people look at the economy and say it feels weak. Inflation pressures remain. Consumers feel stressed. Now let's talk about the US dollar. In 2026, a weaker dollar continues to support US equities. When rates fall and money supply increases, the dollar tends to lose purchasing power. This benefits US companies, especially multinationals, because foreign earnings become more valuable when converted back into dollars. A weaker dollar is not a mistake. It's a feature of the system. Every investor should also understand the concept of the Fed put. If markets fall sharply, history shows that the Federal Reserve intervenes. We've seen this during major crises time and again. A severe market decline threatens employment, credit markets, housing, and government financing. At that point, intervention becomes necessary. This doesn't mean stocks can't fall, but it does mean that major declines are often met with policy support. Looking ahead, leadership changes at the Federal Reserve in 2026 also matter. New leadership typically brings a shift in tone, and historically, that shift leans toward easier financial conditions, not tighter ones. Policymakers are incentivized to support growth, stabilize markets, and maintain confidence. So what does this mean for investing in the US stock market in 2026? It means staying invested. It means not sitting in cash and losing to inflation. It means understanding that volatility will exist, but in a liquidity-rich environment, pullbacks tend to be opportunities, not signals to panic. My approach in 2026 is focused on quality US companies, broad market ETFs, and sectors with strong cash flow and pricing power. I'm not chasing hype, but I'm also not waiting on the sidelines for a crash that may never come. In this environment, dips are meant to be bought, not feared. If you want to follow my investing journey and learn how to position yourself in the US stock market for 2026, make sure you subscribe to the channel. I appreciate your support, and I wish you long-term success in your investing journey.